Hello guys, welcome back to another video. Today we're going to be looking at crypto mining tax. So I know that the tax season or the tax year has actually just passed. So this is for all those new starters that are crypto mining or want to keep records of their crypto mining for tax purposes. This should be a good video for you guys to start on at the start of the tax year, just because when the tax year ends next year, that means that you can refer back to this video and you can implement some of the things that we are looking at in this video across the year, and hopefully it'll make it easier to do the taxes because you won't be recording everything at the end of the year. You can keep a running list of what you've mined and what you've sold throughout the year. So this is based on American tax rates. Now there are some differences between a lot of taxes in different countries. I'm doing this for America just because we have the biggest audience being American. The main thing that we're working on is the federal tax bracket. This is not going to be a state by state one. This is just going to be a federal one. For those people that are living in Texas, where they have no state tax and stuff like that, and the other states that don't have that, that's probably why a lot of cryptocurrency miners go there, also for the cheap electricity. So it will apply to those with zero state tax. However, there is going to be obviously differences between state on state taxes. So the main things that we need to learn is that crypto mining is two taxable events when you're mining and you're selling. So the first taxable event is an income event, and that is obviously when you're mining and the income is coming into your wallet. And then the second taxable event is the capital gains event. So we're going to focus on the income event first, and then we'll go on to the capital gains event. So with income, the income on mining is taxed at the time and date of it hitting your wallet and the price of the coin at that time and date. So from the mining pool into your wallet. If you're mining on a mining pool and you're hitting a bunch of blocks, it doesn't really matter. It matters about when the pool is paying out into your wallet. That's what counts as the income. So this is why I'm saying it might be useful to start running a ledger or making a list of all the times you've been paid out by a mining pool, because then you can actually record the date, the time, and also the price of the coin at that time, because that is very useful. And I would say starting now, obviously because we're at the start of the tax year, it would make it a lot easier to keep track of all of this going forward. So maybe open up a spreadsheet and kind of implement this into your mining payout. So whenever you get one, you add it into the spreadsheet or something like that. So I'm just going to run through a basic yearly salary tax, and then we'll get into the actual income of mining and how that is added on to your salary tax. So let's say that you get a salary of $50,000 per year. You will then have to be taxed 3 times in the 3 different brackets. We're going to be using a single filers bracket for this video, but there are obviously other ones that you can go for, head of household or joint filing right there. So the first 10%, which is $11,600, as you can see there, is taxed at 10%. Then the in-between of $11,600 and $74,150 is taxed at 12%. which is $35,550. And then the extra 22% is this bracket of $47,151 to $100,525, and that is taxed at 22%. So it's a simple calculation. You divide this number by 100, times it by the percentage for all of these, and that should give you the tax that you're going to pay, the income, so income minus the tax, gives you this number. So this is your take home. This is how much tax you have to pay. That's just on your salary. That's a very, very basic way of explaining the tax brackets for you guys. Now, if you're new to crypto mining and you just started mining this year or previous years, it might not flow over into this year. This is the main part of the video which you'll be interested in. And this is the income event that happens when you actually mine to a wallet. So if you're mining from a pool, it's when the pool pays out to your wallet. If you're solo mining on your own node, it's when obviously you hit a block and it hits your wallet. So that's where you record the price of the coin, and then the date and time, and the amount that you are obviously paid. So these are all example transactions. If you are mining a lot of cryptocurrency, I say it would be very useful to keep track of this, starting at the start of the tax year, as I already said, because it could get kind of out of hand if you're getting a lot of payouts, especially if you're mining from different pools on different coins, different mining rigs, and so on and so forth. So we just have some transactions and some payouts of different coins. We have Kaspa, Bitcoin, and Ethereum. We have the amounts that we received and the dates that we received them. Then the price of the coin at the date. I don't know what the stipulations are about the timing of it and where to get the data from. That might be a different thing for Americans. Maybe they have some leeway with what the price of the coin was that day. Or I don't know if you have to have it to the specific minute or hour that the coins were received. But it shouldn't vary too much if the price of the coin is not that volatile. Some of them, obviously the smaller cap ones, would be more volatile, so maybe they might ask you to narrow it down to the minute that it was actually transacted into your wallet. So obviously all of this is classed as income. This is not a capital gains event, it is an income event. So what do you do with this income? You times the amount of coins that you have, times by the price on that date, and that gives you how much you earned for that day. This is also classed as the cost basis and will be used when you're doing capital gains in the future. So we've made this calculation here of all of these transactions that we had going into the wallet from mining, and that gives us an income of $299.05. Then what we do is we add these two together to give us this figure, and then we tax that appropriately on top of this 22%. I know that this is a small figure, but it's just an example. You could have, 15,000 in mining income, and that could add you into a different tax bracket. It just really depends on how much you're earning a year in your job, and then obviously how much you're earning from mining. So you add these together and you calculate it again. So you do just this top bracket because we're not entering into another bracket through this $299.05. We add these two together and then we tax that at 22%. So then we have our new figures from up here. As you can see, the tax has changed. We've taxed for this number instead of the 2,850 at 22%. This gives us a higher amount of tax to pay. And obviously, as you can see that reflected in here, it's higher than this figure here. And then we obviously take the income and it leaves us with 44,180 and 26 cents. So that's a pretty basic way of showing you how to calculate tax on cryptocurrency mining. Now, when it comes to the capital gains event, which we'll cover in a minute, we do have some stipulations and some tax deductions that you can use. Now, I do want to make this very clear. This is only for crypto miners that have run up their crypto mining operation as a business, and not for those that are hobby miners. So there are some stipulations that we will look through as well. So one thing you can deduct off that is the power cost, because as a business, that is an expense, and obviously you can deduct that from your income there. Now, just a quick example of it, power write-off for income. You have kaspa coin, 6,000, price was 5 cents. Then the value of that is $300. Your daily power cost, let's say, is $100. You minus the power cost from the value to give us $200. And then you would tax that because 200 is now your cost basis. As we can see up here as well, this is our cost basis, which we'll use actually in the next part, which is capital gains. And then other deductions that we can do, mining equipment. Under section 179 of the tax code, you can deduct up to 1.8 million in equipment costs for the tax year. You can deduct for repair and maintenance of GPUs. You can deduct for rented space. Let's say you have it separate from the household. You can deduct building mining farms plus solar. So anything that you can justify that goes into the business for specifically mining. For example, you want to build a mining shed, you build it on your property, and then you want to power it with solar. You can do that all through the business and you can get a deduction from that. And then obviously the last one being losses from cryptocurrency. So we do have an example down here. We have Ethereum, we bought 1.2 at 4,000 and then we sold it for a loss of 2,000. We can actually claim this loss back, but this is on the capital gains side. So this isn't classed as an income, this is classed as a capital gains because we're selling an asset. So only if we've lost on assets, we can actually claim back some of that tax that we would be paying. Just one thing to note on the mining equipment, the depreciation for that, I don't really know what the rules are behind it. I'm pretty sure that there should be a standard rate of depreciation for it. However, I do believe that a lot of people will buy mining equipment just to write off some of the tax deductions later going forward in the future. I don't know how the rules are with depreciation. I'm not really too into the crypto mining scene in America just because I'm in the UK. So that's something that you'll have to research, or maybe some people can put it in the comments, what the depreciation rate is for mining equipment in the US. And now we should move on to the capital gains side of the video. So we have two types of capital gains, short-term and long-term. In the short term, which is 1 year or less, you pay it as income and not capital gain. So basically we do this calculation all over again with the amount of cryptocurrency that we sold minus the cost basis. So this all wraps into income tax instead of capital gains tax. And then if you've held an asset for long term, which is more than a year, that's when you start to pay capital gains on the capital gains brackets. So how do we calculate capital gains tax? Now this is a very, very rough version of how to calculate it, but I'm hoping that you guys start to understand how this is calculated. So here we have a 0%, a 15%, and a 20% bracket. This is obviously a federal bracket for the single one. This is what we're basing ours on right now. So there might be people that have businesses with higher amounts of capital gains, as in you could have up to, 50,000 worth of cryptocurrency that you've mined, or I don't really think people would go over 518,000, but it might be possible as a business miner. People that have facilities, they might actually turn over that much, but I'm willing to bet that it's either going to be 0% or 15% for us miners out there. So we have the exact same payments that we have up here, and then we have the date that we sold them, the price of the coin at the date we sold them. As I said, I don't really know if it's by the hour or by the minute or by the day at the price of the coin. You guys can leave that in the comments, those Americans out there. And then the amount of coins obviously that we sold. And then we do the calculation again. So we do the price of the coin at the date times by the amount to give us the amount that we sold it for. So this is all the amounts we sold it for. Now you have to actually deduct what your cost basis was. So it's very important to actually keep a record of the cost basis, because it will help you when you come to do this calculation, and you'll save on tax because of this cost basis. So this is to stop obviously you from being taxed again from income and capital gains. It's basically the two taxable events. They don't overlap. That's basically what the cost basis is for. So you deduct the cost basis that you had up here that was calculated every time you got a transaction in, and then you deduct it from the amount that you sold. That will give you the capital gains that you've made for that cryptocurrency or for that transaction. As we can see here, we have 1,036.92 cents that we were made. So we would fall into a 0% tax bracket. So we wouldn't actually have to pay any capital gains on this. Now, when it comes to the 15% tax bracket, we have an example here. So let's say that this was our amount that we had here. So we sold a bunch of cryptocurrency for this amount. We'd pay 0% on $47,025. And then we'd pay 15% on the extra on top of that. As I said, I don't think many people will be going into the 20%. So I'll keep it at this figure. Then we do the calculation again. So we divide this number by 100 times by the percentage, and that gives us 5,630.60 cents for capital gains tax. So this is our capital gains minus the tax. That gives us what we have left over. So this is what we're going to actually be left with after we pay this tax. As I've shown here, I believe it's called filing in the US. So this is what you would file it under. The 1040 Schedule 1 or with Schedule C for self-employment earnings. So that's the income. And then Form 8949 and Form Schedule D for capital gains. Now these are the tax brackets. As I said, there are stipulations state by state. So you guys will have to look into the state taxes yourself depending on where you're living. Now, I want to come down to some stipulations that I've written down here. And these are just some extra information for you. So swapping coins will fall under capital gains, I believe, because you're swapping it into a currency. However, if you're swapping into a native currency, as in a USDT stablecoin, then the taxable event will happen, but you won't actually lose anything. You'll only pay the capital gains on that income, and then if you sell that off, that means that you've made the sale of the exact amount of USDT. So it's a bit of a gray area when it comes to tax, because you haven't actually made or lost anything if you're converting into a USDT and then selling that offwards. It does, however, matter when you're converting from pairs of moving assets. For example, Bitcoin to Ethereum. Let's say the price of Ethereum moves up and down relative to the price of Bitcoin moving up and down, it's a very strange calculation that you'd have to do there. I wouldn't recommend swapping them just because it adds a bit more layer of complexity into actually calculating the capital gains. One thing that we could use NFTs for as well, if you bought a lot of CryptoPunks or any NFTs in 2021 or 2022 when they were at their height and you've made a loss on them, you can actually record that loss in the capital gain section as well, and then you can get lower on your tax bill. So for NFTs, you can actually reduce it. If you have any NFTs that have basically gone to the bottom of the floor in terms of price, you might as well sell them and recuperate some of that capital gains tax. I'd only recommend that if you're over 47,000. If not, I wouldn't really bother. And then obviously, as I said, the state tax varies by state. Filing as a business or a hobby miner, the hobby miners don't get to take advantage of any of these deductions. Only if you're mining as a business, you get to take these deductions. So I don't really know what the rules are behind businesses in America. I believe that you just have to prove that all of these deductions actually assist in the business. For example, building a mining farm, renting space, repair and maintenance on equipment, mining equipment depreciation, and obviously power cost, which would actually fall under the income side. And then the losses would fall under the capital gains side. And then I did see on Twitter, coming down to our next point, MineSum10, big shout out to him. He was talking about American taxes and taking large payouts from pools. So there is a way to actually reduce the amount of tax that you'll pay if you're thinking of holding the cryptocurrency for a long time in a mining pool. You do have to trust the pools, obviously, to do this. But what you could do is you could save up a bunch of mineable coins, and then you could wait until the next bear market. As long as you have your minimum payout set extremely high, you could actually take that out, and then it would actually reduce the tax that you're going to pay on the rest of them. So it's a bit of a gray area as well. However, it does matter because the taxable event comes when the pool actually pays you out. Now, one thing I do want to mention about this is that mining pools will probably require KYC going forward into the future. You know, exchanges are already regulated with KYC. I'm having a feeling that mining pools will as well, just because it makes it easier to track the mining payouts. And there might be some different rules around mining payouts as the time goes on. So I'm thinking maybe the big mining pools will have to comply with KYC, and then it'll probably be smaller mining pools that don't actually comply with KYC, which will probably actually for the miners receive a lot of hash rate, just because people don't want to bother with KYC on a mining pool. And then, as I said up here, depreciating mining equipment. Other investments apart from crypto is a big one. So say you have investments in stocks or in gold or silver or any assets, you can also add that on. And if you've made losses on them, you can record those losses against the cryptocurrency that you've sold. And then lastly, we have gas fees. So I know for a lot of cryptocurrency that we have small gas fees, but obviously with Bitcoin and Ethereum, Solana, the gas fees are relatively high compared to, you know, a kaspa or an Ethereum. And if you have sold Ethereum, you can actually write off the gas fees and you can take that deduction on the capital gains as well, I believe. And I believe the same goes for a lot of other gas fees that you'll be paying. Now, I wouldn't really bother unless it's like a really high fee, like you've paid $100 or something like that. You might as well take that off if you're in a higher tax bracket. So gas fees do count as a loss because it's a taxable event, and therefore you can actually reduce some of the tax with the gas fees. So that's it for the whole tax video. If you guys have any questions, I will try my best to answer them in the comments below. If you have any suggestions of different ways to actually manage tax in cryptocurrency mining, then please leave them in the comments below. As I said, I'm not native to America, so I'm not heavily deep into the crypto mining taxes, but hopefully this was a basic understanding for you newcomers into it on how to actually utilize this tax bracket and record losses and so on and so forth, and deductions for crypto mining. So if I've got anything wrong in this video, just feel free to correct me. I'll pin the comment on the video just so those people that are watching in the future have more information there. Remember that these tax brackets do change year by year, so keep an eye out on these, and I believe you can find them on the government website for federal tax brackets. Make sure you like the video and subscribe for more content like this.